Okay, I think we'll get going, yeah. So you're very welcome for this first, I say this first, I hope this continues, this first winter school on modern finance and macroeconomics. And you're very welcome. And I know you're from all over India, many states. You're very welcome and hope you find the summer school very useful and productive in terms of exchange and getting new ideas. Just a brief introduction about the, can you hear me? Can you hear me? Yeah, okay. Okay, then it's fine. Introduction of this facility we have. It's a wonderful facility that you saw. It's called the International Center for Theoretical Research. It's a TIFR center, which is Tata Institute for Fundamental Research Center. It was founded in 2007. And this building just inaugurated in 2015, this new facility. And the program that this is the fourth program of this year. They usually do about 15 programs per year on various multidisciplinary themes, biology, physics, and all kinds of themes, not just in economics. And they were quite excited. And when we approached them about this particular idea, they got pretty excited and they helped us, they encouraged us to create a winter school of this scope and size. The founder director, would like to thank the founder director, Professor Spenta Wadia, and the current director, Professor Rajesh Gopakumar, and also the dean of the programs was quite helpful, Professor Avinash Dar, who helped us to organize and put together the proposal. They helped us in every detail of this program, including the money, travel, and all kinds of infrastructure facilities. So as you see, this is a new building and the facility is coming up, so we regret for all kinds of inconvenience that might be caused due to all this construction that goes around. We also like to thank scientific coordinator Manasi Shinde, who immensely helpful in getting together. You can imagine Professor Shrikant Iyer and Professor Vishu Guttal collaborating with them. I'm far away and they are in India, so kind of communication was quite challenging at times, and Manasi Shinde was quite helpful, and Sashi Kiran was quite helpful, and Mayank Sharma on the web page, setting up the web page and getting the applications and so on and so forth. And also the audiovisual team, we're going to record all the sessions, will be put up on the web pages. Irshad and Shantraj and Srinivas, all of them, we thank them immensely for all your help and support during this 10-day winter school. So I'll hand it over to, I just want to briefly introduce my friends and collaborators and co-organizers. Professor Shrikant Iyer is a mathematician, is in the School of Mathematics in Indian Institute of Science. And Professor Vishwesha Guttal is an ecologist in Center for Ecological Sciences and Indian Institute of Science. Also take the occasion to thank the participant as well as the contributors, Professor Gary Dumsky from University of Leeds, and Professor Petri Purainen is a mathematician from NUI Galway, where I work in Ireland. Is right there. And we will have Professor Amit Baduri, JNU, an economist, and Professor Anjan Mukherjee, and other mathematicians, Professor Karmeshakar from JNU, and I'm missing one name. Professor Gennaro Zedza is going to arrive on 26th. He's an economist, well-known proponent of stock flow consistency, macroeconomic models. He's from University of Cassino, Italy. So we will have, I hope we will have a fantastic session, 10 days with fruitful exchange and hopefully for possible future collaboration and networking opportunities. And also see what kind of difference that we can bring to this interdisciplinary subject of finance and macroeconomics. I'll hand it over to Professor Vishwesha Guttal, who's going to give some announcements on various details. You want this? Oh.
Hello, good morning, everyone. I only have a few general announcements. regarding various facilities at this center. First of all, you already know there is a registration desk outside. For most of our coffee tea breaks, it should be, there must be somebody who is going to be there. So if you have any general questions, you can ask the person who is going to sit there. And then today in particular, there will be a travel desk from 1 p.m. to 5 p.m. So if any of you would like to sort of go outside in Bangalore in the evenings or when there are breaks, you should ask them for more details. And in particular, they're actually happy to arrange some kind of a transportation for those who would like to go out on the 31st of December. Of course, you'll have to pay for that on your own. ICTS won't sponsor that. So if you would like, I should contact the registration desk somewhere closer to the date. Okay, and the same registration desk also has TADA forms to all those of you who would like to get reimbursements. So I hope you have already collected them, and if you have not, please do so in the next break. And then you're requested to sort of submit that back by tomorrow evening. Wednesday evening. That way they can start processing all of your requests. And so there is coffee tea, as you see, there is a small desk with, a small kettle that's going to be there all the time during the conference time. So if you're feeling sleepy, you should go and have lots of coffee. And in addition, we're going to have lots of coffee breaks in between as well. And that's going to be in the foyer area, just outside where you enter this building. And during the talks and discussions, if you really need to go out, please use the back exit there. Avoid using the main entrance for both coming and getting out. Of course, this will go to the first floor, and you have to get down if you want to go out. And there is actually a printer on the registration desk, and there are instructions on the notice board how to use them. The IP address and all the related settings are posted on the notice board. So if you need to, if you're not very sure, just go and ask the registration desk during the break times. I don't know your name, sorry. Shantraju, he will always be around to help if you have any such questions, okay? And there are a bunch of other instructions as well, such as map of the campus, and then, directions for getting into city if you like, and the shuttle timings to NCBS as well as IASC. So all those information is available on the notice board. And apart from this, if you have any more questions, you can ask us now or any of us during the break times. Okay, so I am assuming that most of you are staying on in the accommodation that's provided here, and the center would really like your feedback on what's good, what's bad, what do they really need to improve it. So feel free to let any of us know during the break times. Okay, thank you. Yeah, I think I covered everything I have to say. Okay.
Yeah. Okay, so let's I might use the board, so I might need to light something later on. Okay, thanks. So the formal announcements are out of the way. So I'm going to give you a broad introduction, broad brushing the macroeconomic literature and the context to why we are doing this, as well as the issues that we actually have in the literature, the recent literature under financialization, and the challenges that it poses for understanding these issues from a theoretical and as well as applied policy analysis. The idea of the winter school came, if you look at the recent developments, particularly you have two broad groups in Europe, across different countries in Europe. I call this European group of loosely called as heterodox economists, who are Keynesians, post-Keynesians, Marxians, and structural Keynesians, and so on and so forth. And there is another massive group in the US. And the lot of debate, the crisis, particularly after the crisis, in the context of the crisis, it has had a profound impact on both the profession in terms of research as well as teaching. Okay, in terms of research, you see these kind of groups, particularly the European as well as the American group, which started talking about, I mean, it's revisiting older issues like classical issues and the Keynesian issues, revisiting these issues in the context of financialization, and began a great momentum. This is at one level, at the research level, where there is a kind of a acceptance that yes, we are very diverse, the heterodox community is very diverse, but at one level we need to come together to engage in this issue, in the broader issue of financialization, to understand what exactly are the generative processes and how do we tackle these kind of issues with policy. And it became a paramount importance for us to come together at this time. Even in the mainstream policy communities, you hear, backbenchers mutterings saying that, well, this is not great enough. I mean, we need to do something about it. Even the policy model, which is called the dynamic stochastic general equilibrium model, which I'll give you a short introduction to it. Even there, you see there are some improvements. They're trying to bring the kind of critical views that's been articulated from outside into this modeling framework for policy analysis. I mean, you hear these mutterings. So this is at the research level. You can see a lot of movement, a lot of activities that go on, is going on both in Europe as well as in the US. And at the teaching front, you see in 2010 the first student uprising in terms of in the Harvard University, students came out and strongly protested that we do not, Gregory Mankiw is one of the guards in macroeconomics, and his textbook is going on for 11th or 12th edition. The second year undergrad students, they came out openly and said that, look, we want pluralism in economics. You cannot possibly teach the same thing over and over, even after the crisis, right? So there was a uprising. I would call that as an uprising. It was a student movement, genuine student movement. They wrote a letter signed by all over, all across Harvard, also circulated around the world, and that is one. And in the UK, you see in the Manchester, University of Manchester, you have post-crash economic society. Students protested that they do not want to have the same curricula. They want a change in curricula in economics teaching, because they think that this is one-side story has been told many often, even after the crisis. So they wanted diverse views to be incorporated in the curricula and so on. So that actually spread. That movement spread. Post-crash economic society hosts conferences every year. Now the third conference this year they had, and so student movements are coming up in UK as well as in Europe, and particularly in UK there is a group of people who are working, a group of economists, I would say that from the heterodox community. They are actually trying to create what they have, this CORE. If you Google core, you will see a curricula that different authors have put together a lot of textbooks for common people to read, not just common people who don't have background in economics, to understand the issues in economics. So something like, the title goes something like, there is a textbook, there's an e-textbook that you can download and go through and so on. This is the context. I mean, this is a broader movement that is happening, at least in the West, particularly where the crisis has hit very severely. And the idea of this summer school is the first thing is to bring that debate here in India, in here, to expose students from economics and students from other disciplines, students who are interested in economics, students who are interested in finance, who wanted to know what's going on around the world, to locate that debate here and see what kind of reactions that we get and what kind of discussions that we can have. Can this trigger some kind of dialogue within the research and student community here in India? That is one aspect to this. That is one of the aims of this winter school. That's the origins of winter school. Second, more rooted aim is that I started working with Vishu Guttal and Amit Baduri in 2012 when I came for a sabbatical. I was visiting Indian Institute of Science, and with Srikant Iyer, we kind of discussed quite a bit about how do we understand. There's so much of the economics that it's been taught, the mainstream economics that has been taught. I keep saying mainstream economics because it's the dominant economics that you actually see in the textbook. It's kind of sometimes you feel it's unreal. Even after all the crisis, which is like. Crisis, the proportions of crisis, the implications of the crisis is huge. The real human cost of crisis in Europe, it's average 10% of unemployment. And in particular countries like Spain, it's about 25% unemployment. Youth unemployment is 40%. And there is a real human cost to every crash and every crisis that followed in the financial crashes. It's as if the textbooks speak as if nothing has happened. You still have the same methods, models, metaphors, and theories that's been rattled over and over every time, as if nothing had happened. Okay, the crisis happened. Okay, let's get on with our business. We need to do our own models, marks, degrees, and this machine is rolling all the time. So we kind of talked a lot about how do we. The interest is basically to how do we make economic model more realistic. That means you really have to take into consideration the feedbacks that we have, multiple timescales, the feedbacks, the dynamics. All that has to be understood from an economic standpoint. You start with an economic problem and ask, okay, how am I supposed to understand this issue of there is a growing economy, but the growing economy actually creates fragility in the system. So how am I supposed to understand this phenomena? Okay, so this is where we started, and we formed a small group, and we continued to work together, and that is the intellectual basis for this winter school. So with Vishu Guttal and Amit Badre, we published a paper in Macroeconomica, and also another paper with Vishu Guttal on looking at the data for major crashes and many mini crashes from 1929 onwards. This body of work, that what we're trying to do here, and with some students, with Shrikant Iyer and one of his students, we are working on a broader model of dynamic instability and so on. All these works and our discussions and our, I would say, aspirations are the intellectual basis for this workshop or this winter school. Okay, so with that brief introduction of the where the origins of this winter school, and we hope that we might be able to continue this in the long run, and we'll see how this goes, and then we'll take it from there. So what I'm going to do is I'm going to give a kind of broad brush context and the issues and the challenges that we have. So in 2008, British Queen went to London School of Economics, and asked the assembled scientific community, why didn't you see this coming? Simple question. Why didn't you see this crisis coming? And she asked, what are the measures taken to fight it, fight this kind of recession? So two fellows in British Academy, Professor Tim Baisley and Peter Hennessy, they replied saying that, well, many people did foresee the crisis, but the difficulty was seeing the risk to the system as a whole rather than to any specific financial instrument or loan. Risk calculations were most often confined to slices of financial activity using some of the best mathematical minds in our country and abroad, but they frequently lost sight of the bigger picture. And they said, so where was the problem? Everyone seemed to be doing their own job properly on their own merit, and according to standard measures of success, they were often doing it well. The failure was to see how collectively this added up to a series of interconnected imbalances over which no single authority had jurisdiction. This, combined with the psychology of herding and the mantra of financial and policy gurus, led to a dangerous recipe. Individual risks may rightly have been viewed as small, but the risk to the system as a whole was vast. So this was the reply, and I don't know, Queen, whether she ever got back to them. I think I think the communication ended there. Anyway, so what I'm going to try to argue is that there is a dominant diagnosis of the crisis, okay? And that dominant diagnosis does not take into account the underlying empirical facts that have been observed over the period of 15, 20 years, since the 80s. And dominant discourse or the dominant diagnosis basically locates the crisis exclusively in the financial markets. What I'm going to try to convince you, using the data that we have in the literature, that there is an alternative way to see this, okay? And that is what we are harping. And that alternative story is much more rooted in the institutional and the empirical facts of how the Western and the financial capitalism or the financialization phase has evolved from the 80s, and which actually, requires a different way of understanding, modeling. So it has a substantive content, and it requires a methodological content which we need interdisciplinary pursuit. This is the crux of what I'm going to say. Okay, so to motivate you to see these 2 points, the dominant diagnosis as well as the alternative view, we'll start with comparing the Great Depression and the current crisis. Okay, these are some of the quotes during 1929 and 2008. I mean, if you compare this is called the Great Recession. 2008 crash was called crash, and then the following recession is it's called Great Recession, and the Great Depression. And there's so many indicators it compared in terms of world stock market indices, volume of trade. The red line is the 2008 and blue line is the 1929. And world industrial output fell. And individual countries, they shrunk, like France, Germany, Italy, and UK. On Canada, Chile, Japan. USA had a lesser fall than other countries, and relatively to 1929 depression. So you can see that in comparison to 29, it is a serious crash and recession that we are in. We're still in recession in Europe. And this is, Paul Krugman uses this for bad bear charts. He compares all the, which were 1929 to 32 Dow Jones crash, S&P 500 in 73, 74 oil shocks, the 2000 dot-com burst, and 2007, 2009 in the blue. You can see from the crash period, how long the market was in recession on the horizontal axis. So you'll see how much it fell as well. It fell about 89% in 1929 crash, whereas it fell about 56.8 in this crash. And the number of market days, the financial market by itself, because this is an index itself in recession, was about 400 days. And then now the Dow Jones is doing quite well. It's gone up beyond the pre-crash levels. And S&P 500, the current, this was in 2012, the current snapshot was it's to show that it's gone back above the pre-crash levels. So it spent about 35.8 months. That's what he was arguing, that it is one of the longer recessions that we in the contemporary phase. And 2013 again, it just jumped back from October 2007. It crossed that October 2007 mark. What happened in Europe? So what started in US, the crash, the abrupt crash that happened in the stock market, but also contagion effect that went to European economies. You have Ireland, Portugal, Spain, Greece, Italy, where the peripheral economies were worst hit. And you see the sudden dip after 2008 in terms of GDP growth per year-on-year growth. Unemployment, obviously, it shot up. And the average unemployment is still about 10% in Europe. And in Ireland, it's about 9%, 9.6%. And Spain and Portugal are still, Spain is very badly affected, about 23%. Youth unemployment is 23%, and aggregate unemployment is about 10 to 12%. And European manufacturing index, okay, all the indicators, the aggregate indicators that you saw, that you can see, everything. So this is a recession. Following the crash, the economy, the actual definition of recession is the 2 quarters. If GDP is below, it is in negative territory. The percentage growth in GDP is in negative territories. For 2 quarters, it is officially recession. One major difference between depression, Great Depression, and the current crisis was the private debt, the debt to GDP ratio. So in USA, the debt to GDP ratio was about 275%, and you can see from 1940 onwards the accelerated growth in debt to GDP. Then if you divide the aggregate in terms of the components, you see the financial sector's debt in the red, business sector, corporate non-financial business sector in blue, then you have household sector's debt in black, and the government's debt So this is since 1990. And what makes up this private debt? You have the gamut of instruments that you see in the financial markets. Securities, derivatives, CDO squared, all kinds of fancy, very complicated financial instruments. And all of them are in off-balance sheet activities like special purpose vehicles and so on, junk bond activities. So the institutional context to all this Gary will talk more in detail about the institutional context of the financial market. So this is what you have. So what is the dominant diagnosis that's been so far? The dominant diagnosis has been subprime mortgages. The blame was basically on the subprime market. So everything is on subprime. So from subprime, you have the commercial banks created this special purpose vehicles for securitization. The securitization process was criticized. That is the villain of the piece. And then you have further re-securitization in terms of CDO squared, and the insurance products like CDS on these complex products. All this created this mess. So regulation was lax, and because of the complexity of these instruments, the price discovery aspect of the market was completely lost. This aspect, Shrikant Iyer will talk about this in detail, about the pricing issues arising in the pricing of these complex derivative products. Now, then the entire narrative was basically on the subprime and defaults arising from the subprime mortgages that actually shook the system. The cascading default, which created contagion, and this is in terms of US, where the possibility of default or the subprime foreclosures in different states. That's the data, and the typical loan book of a commercial bank. You can see the securitized loans occupy about 20% of their balance sheet, and real estate about 11%. And so you can look at the balance sheet of a commercial bank and see that there's much larger activity of commercial banking into investment banking activities that went on in that period. And popular press took to fancy, and you have all kinds of subprime inferno. And the popular press, everything, rating agencies were criticized because they were the underwriters of many of these instruments. Central banks, because of the lax regulation. Ireland had a inquiry, not public inquiry, the parliamentary inquiry on the banking collapse, which had called the ECB's former ECB chief and so on and so forth. So regulators, subprime, greedy bankers, that's where the popular commentary went to that direction, including Warren Buffett kept saying that, well, this is weapons of mass destruction, these CDOs and CDO squared and CDS are. And it actually closely matches the Daniel Defoe's, the Anatomy of Exchange Alley was published in 1719, where he talks about, the stock exchange is a complete system of knavery, and the trade founded in fraud, born in deceit, nourished in trick, cheat, wheedle, forgeries, falsehood, all sorts of delusions. Well, it aptly fits the description, and it was used in the current crisis as well. If you look at the Times, 2007, April 28th, you will see this exactly the same description that was used for describing the current crisis. Then came the bank guarantees in Ireland and in Europe, countries in Europe. The private debt was taken over by the governments, and because it's too big to file, the market sentiments are too, they will not take it, because if you allow people like Lehman Brothers to fail, well, the market will not be kind to you, because you need to go back to the market for borrowing. So it will put you a very high premium on borrowing because you didn't bail out these banks. And it also, if you let go banks which are too interconnected to fail, then you have serious credibility issues. So not saving Lehman Brothers is still seen as a reason for this protracted recession. And example, Irish fiscal deficit, It was in surplus till 2006, and then from 2008 onwards, you had massive deficit, and then the story, what happened, adjustment, IMF, Troika, and so on. The entire austerity program followed after 2008. We'll just see briefly. And the Eurozone government debt across different governments, because they all took over the private debt. You have Germany, Italy, and France, and so on. You can see this is this data of gross government debt across Europe. So this has been the kind of the dominant diagnosis that many of the economies, regulation is one of the lax regulation. The financial markets did not, because of lax regulation, greed and so on, the inefficiency in the financial system just took over. So that's what's happening right now in Europe. So the entire regulatory architecture in Europe has been re-engineered, reorganized in order to make sure that this kind of crash never happens again. Okay. I think Gary will touch on these issues. Now, if you look at the economic policies then and now, then meaning in 1929 and in 2008, what you had in Bretton Woods, aftermath of Bretton Woods Agreement, you had counter-cyclical policies. That means when you're in the boom, you have kind of tight policy, monetary policy, and when you're in recession, you have an expansionary policy. This is the counter-cyclical nature of policies, inspired by, obviously at that point in time, you had John Maynard Keynes. Keynesian revolution was at the heart of this agreement, and the chief drafters of these, you have Harry Dexter White and John Maynard Keynes. Harry Dexter White was the chief drafter. The whole agreement specified that one purpose of this institution is to avoid competitive exchange depreciation, because countries were depreciating in a competitive way to make them profitable, to cover themselves from the crisis, from the depression. So after the roaring 20s, 1920s was called as the roaring 20s, and then the stock crash of 29 led the Great Depression, saw the abandonment of gold standard, and countries moved towards competitive devaluation, leading to beggar thy neighbor policies. So your exchange rate is less than mine, that kind of competitive devaluation that was happening. So it was important for both Keynes and White to have this motivating principle that IMF, International Monetary Fund, which later to be called as International Monetary Fund, was to engender post-war economic growth by establishing an institution that would prevent a relapse to autarky and protectionism. That was the motivating principle that were operating at the time, not just to avoid recurrence of depression. So if we look at the Articles of Agreement, Article 1 of Articles of Agreement, which sets out the purpose of the fund, includes the objective of using IMF lending to provide member countries with opportunity to correct maladjustments in their balance of payments without resorting to measures destructive of national or international prosperity. Article 4 sets out the system for achieving the purpose by establishing a system of fixed but adjustable exchange rates through agreements to be reached under the auspices of the fund. So the IMF was basically, the organizing principle was you have you want to protect and engender the world economy by not letting the individual competitive devaluations completely destabilize the world economy. So the counter-cyclical stabilization policy, fiscal and monetary policies, to avoid maladjustments induced by competitive exchange rate devaluation, this was at the heart of the framework under which the agreement was signed. So Harry Dexter White's memorandum, prepared by L.B. Curry and Ellsworth and White in 1932, explains the road to recovery via three policies. You have banking policy, you have government expenditure policy, then tariff policy. Now, L.B. Curry is the highly visible man of this and the leading advocate of expansionary fiscal policy. And so the inspiration was from the Keynesian argument that you need government kind of expansionary policy during recession, or the counter-cyclical adjustment that you need in terms of recession and the booms. Harry Dexter White, the personal note was he fell victim because he embraced not embraced, but he went with the Keynesian doctrine and so on. That's as far as the history goes, that he died of heart attack after a strenuous hearing at the House of Committee for Un-American Activities. There's a lot of economists who moved from the US at the time into Europe, like Richard was one of those economists who moved from Harvard into Europe, saying that, he was, I think he famously said that I can be left and left alone in Europe. That's the quote that he said when he came to University of Siena. John Maynard Keynes, most of the economics students, he's well known outside economics as well. He has a lot of books and transformational books like the General Theory of Employment, Interest and Money in 1936, which actually transformed. And he also is a probability theorist, treatise on money in 1930, tract on monetary reform. He's also an economist, but he had amazing persuasion. Gary will know much more than I do in terms of Keynes's own kind of persuasive argumentation in terms of using economic arguments and saying it in very simple language to convince people, the common man. And he was in King's College, Cambridge. And the book 1936 actually did have a transformatory moment in the history of economic thought, and also his history of economic policy and activism and so on. So this was the context, the broader context for the counter-cyclical policies that were enacted after the Great Depression. Whereas you have in this recession, you have the policy prescription has turned pro-cyclical. Okay, so fiscal austerity in the time of recession, that's become the main policy proposition that IMF has now. It'll be interesting to see that history of IMF itself is quite interesting. How they actually change from counter-cyclical to pro-cyclical policy is an interesting history. There are a lot of work on the history of how it turned and so on. I can point you to some other literature on this work. But the idea, the logic of austerity itself comes from these kind of arguments. You see articulated in 1980s, particularly after 1980s. According to convention, I'm quoting this work, Helwig and Newman, 1987. According to conventional wisdom, any policy of consolidation is austerity, consolidation is likely to contract real aggregate demand in the short run. This is Keynesian conclusion. However, this is misleading as it neglects the role of expectations. A more adequate analysis differentiates between the direct demand effects of cutting the growth of government expenditure and the indirect effect of inducing change in expectations. The direct demand impact of slower public expenditure growth is clearly negative. Fine. The indirect positive effect on aggregate demand of the initial reduction in expenditure growth occurs through an improvement in expectations if the measures taken are understood to be part of a credible medium-run program of consolidation designed to permanently reduce the share of government in GDP, and thus taxation in the future. So it basically argues, that the direct, contractionary effect of reducing government expenditure is fine. That's absolutely negative. That's okay, but it is almost more than outweighed by the expectations of the market, basically. So if you have if you take credible measures to reduce your fiscal deficit, reduce the expenditure of the state, of the government, so that the state expenditure releases funds to private investment, and if this is well understood by the market, and not only understood by the market, also believes that these are credible policy stance, not just today I'm reducing fiscal deficit and tomorrow because of elections I'm going to increase my fiscal deficit. So we want a credible medium-run set of proposals that will actually enhance expectations about future growth of the economy, which will actually give you, that will offset any negative impact that the reducing government expenditure can have on aggregate demand. This is the logic. You'll see again and again, the German fiscal consolidation view is exactly the same. You'll see the fiscal consolidation had a benign impact on expectations. An important explanation is the way fiscal consolidation was actually brought about. Rather than raising taxes, the deficit was reduced by keeping a lid on expenditure growth. By absorbing a smaller share of GNP, the public sector made room for the private sector to expand. So it's like you have one part, and if one part of, let's say, 100 euros, the government takes 80 euros, only 20 left for private sector. So if government withdraws from that, if it actually reduces its expenditure to 20 euros, that remaining 60 euros is released for public. This was the intellectual basis on which the fiscal consolidation view. It was called in 1930s the treasury view and so on. This is what Keynes was up against. This cannot be done. The logic as a whole in this. We'll come to that. Now, if you see, this is called expansionary fiscal austerity. It's by raising the expected future disposable income for households and thereby increasing confidence of investors, the fiscal consolidation can thus stimulate private consumption and investment even in the short run. Olivier Jean Blanchard is in 1990, very famous economist, IMF. He has served in many of the boards and so on. Even the European Commissioner, EU Commissioner Jose Manuel Barroso in 2011 said, without confidence, we have no investment. And without investment, there is no growth. And this policy stance is called the expansionary fiscal austerity. So it's like I saw this watching on television, Irish television, with my horror. You have this famous economist in Ireland who is a policy guy. So he goes on national television in 2010, 2011 when the crisis hit and the whole media was after this. And he says, well, if you want to understand fiscal austerity, this is how it goes. He had a sponge in his pocket, so he came well prepared. So he put the sponge on the table. He just squeezed it and then put it on the table and said, see, the sponge has come back to its original shape. So this is so if you cut the economy into, economy has grown to unmanageable sizes, particularly the financial sector. You cut down the expenditure of government, then the economy will grow back. I call this hedge cutting logic. When you cut the hedge will grow back. So this is basically about expectations. So they say, well, expectations about future growth, if the policy stance is credible, it will actually bring the expansion in output even in the short run. This is basically the expansionary fiscal austerity. Now, so what is the next question? What informs this policy? What is the model? What is the framework that informs austerity policy? This again, so you can see this was classic. I mean, it's called this general equilibrium models. You can see that now the new version of that is called the dynamic stochastic general equilibrium models. Now, DSG models, they're used by European Central Bank, IMF, all kinds of central banks. I'm sure Indian Central Bank also uses. IMF uses a version called Globally Integrated Monetary and Fiscal Model, GIMF. Incidentally, I've been using this particular site to show students this is the kind of policy model that they use, monetary policy model that they use. I've been using this. I used it even this July, and now yesterday I looked up. This site was gone. This is gone. This is taken away. There's a lot of huge uproar against DSG models used by central banks, but notwithstanding all this uproar and criticism, you still have like European Central Bank uses it has changed the name. One, it has changed the name to Stochastic Dynamic General Equilibrium Model. Second, it has another name. It has some triple N new model with rational expectation something. And the Irish Central Bank is putting a lot of resources in developing these kind of models. We'll come to the core idea of this model. Not just the central banks. You can see the advisory panel on tax reform for President Bush in 2005. The Treasury Department used variants of 3 standard economic growth models to estimate the dynamic response associated with the panel's reform options. a neoclassical growth model, which is DSG model, an overlapping generations model, OLG life cycle model, and a Ramsey growth model. This is the report of the President's Advisory Panel in 2005. Now, so what is this general? I mean, what it looks on, sounds big. It sounds very complex. Okay, dynamic, stochastic, general equilibrium model. If you look at the building blocks of that, is basically the kernel of that model is a equilibrium model. So you consider an economy as a equilibrating system, right? And the metaphor of this is basically, you can think of a metaphor of the rocking horse, that you can see the rocking horse in a stable position, and if you perturb the rocking horse, it will oscillate this way, that way, and finally it will come back to its original position of rest. Now, what they've done is, so it's basically that, I don't want to show this on. So what they've done with the rocking horse is that you have this, so this is what we all know can you see this? So this is the demand curve and supply curve that we always study, okay, P and Q on, yeah. And this is your equilibrium. So if you perturb the equilibrium, the equilibrium will somehow, so exchange, you start haggling, the process of haggling will take you to equilibrium. And there are conditions for you to get to this equilibrium. It's not obvious, but it's the slope, the ratios of the slope of the demand curve and supply curve should be in such a way that the market should clear, okay? Now, the metaphor is basically your rocking horse. Now, the perturbation technique that they use is basically if you perturb the system and it will come back to its original position of rest, and it is at this point exchange actually happens. Nowhere else exchange happens. So here you have, at this level you have excess supply, excess demand, and here you have excess supply. So prices will somehow equilibrate the system, right? So excess demand means prices will go up, excess supply, prices will go down. The prices are the equilibrating mechanism in this model. It doesn't matter which market you consider. It could be potato market, it could be labor market, it could be financial market, it's all the same, okay? You can see this in a very simple closed economy situation, that you have the household sector and you have these firms, and this, everybody, people would, economic students and non-economists would know this. So it's a closed system. So firm hires the labor from the households and it pays wages. So you have labor is hired and wages is being paid. Okay, this is the wages. And so firm hires, so it pays wages. And then with their wages, they buy their products and your profits are earned. Okay? The revenue for the firms. So this is a closed system, right? And it's a closed loop. There's no leakage here. Now, even if you assume, and in this, what happens? There's a product market, that is, the product is being bought, whatever is being produced by the firm using the labor. There's a labor market. The labor decides how much to supply. So what is the idea of a labor supply? Is that you assume that there's one guy, the two guys here. So the labor basically has to decide how much to supply to the market and how much to take rest. So he has 168 hours per week, and he has to decide how many hours that I should work and how many hours that I should take rest in order to maximize his own welfare, right? His utility or welfare depends on this, work come leisure. So, and the consumption of what he buys in the market. So that is the optimization problem of the household or the labor. On the other hand, the firm's optimization is what? He has to maximize his revenue or profit. So there is assuming the prices are taken, they can't influence the prices. He has to maximize his profit. So he has to say how much labor that I should hire and how much I should produce for the market. Okay, so he has to maximize. So his decision, how much to hire the labor, okay, the demand for labor and supply of labor by the household gets resolved in the labor market. Okay, and how much demand that this guy actually, how much money that this guy spends with his income to buy the goods of the firms, and the supply of goods gets resolved in the product market. So both markets clear, okay, using the prices. If there is excess demand or excess supply in one of the markets, they clear through prices. The prices in labor market will clear excess supply of labor. That means price of labor, that is wage rate, will go down. Excess demand for labor, wage rate will go up. On the other hand, excess demand for product, prices will go up. Price of product will go up, and excess supply of product. So basically, prices coordinate these independent decisions made by these two guys. They somehow coordinate, magically coordinate, and create a macroeconomic welfare, right? Both of them maximize their utilities. This guy maximizes his utility. This guy maximizes his profit through this price mechanism, okay? Even if you prick a hole, if you say that there is a leakage, suppose if this guy actually saves some amount of income, right? He's not spending all his income on the product. He's saving some, is saving something, some income, some part of his income, and puts it into this capital market or bank, okay? And that saving automatically gets back into this loop in the closed system as investment, okay? And this is basically, even if there is a leakage, your savings is automatically translated into investment, and this is basically the equilibrium condition, isn't it? Savings should be exactly equal to investment. So whatever is being saved is picked up by the firms for investment. That's it. There is no, again, the loop is closed. So you can try many ways. So you have government which does taxes, it pay, and it does expenditure and it takes taxes. Well, that is budget deficit, government deficit. Okay? And if there is external economy, like you have export and import, rest of the world, again the system is closed, right? You're importing, let's say, and then exporting, importing this way and exporting this way, again it's closed, right? The loop is closed. Now, everything, you see, fundamentally it's about your decision to supply. The labor is intertemporal choice about how much I should work and how much I should take rest, okay, in order to maximize my own utility. Similarly, it is how much, given how much I should hire labor and in order to maximize my profit. So that's why it's called a supply side. Whatever is being supplied in the savings, in the loan, it's called loanable funds theory, which is whatever is being saved in the banks are automatically picked up by the firms as investment. It goes back as an investment. So there is no consideration of, why would this automatically go as investment? It is not clear. If there is no demand for whatever being saved, why should it automatically go into investment, back into the economy as investment? So this is basically a rough, very broad introduction to this neoclassical general equilibrium model, okay? And it is a general equilibrium model because it's an entire macroeconomy that we are talking about. You have product market, you have labor market, you have financial market, which is the price in this financial market is interest rates, okay? So if savings is greater than investment, your interest rate should fall. If investment demand is greater than savings, interest rate will rise. And export and import, your exchange rate, and government deficit, and that's, so you have basically you have what? You have markets, people who are making their decisions independently of their own choices, being coordinated by this beautiful thing called market. And if market works perfectly, if there is no frictions in the market, like in the labor market, if there is no frictions, like suddenly labor unions don't say that you cannot cut our wages below a certain level, okay? And that's it, that's a friction. You can't have that, because if you have a friction, then prices will not go down below that, and you have unemployment. So problem of unemployment is solved by cutting the wage rates. It's like potato price, you cut down the potato price. So you cut down the wage rate so that excess of people who are unemployed come into labor force. So basically this is a rough idea of the general equilibrium. Now this is how it works. So in property market or in the rental market, you cannot have rent control. You can't have such a thing called rent control. You cannot have any frictions. You cannot have any distortions in the market. If you leave the markets on their own, they will coordinate. They have inherent capacity to coordinate these independent decisions made by different sets of people, and the efficiency of the system will drive the efficiency of the social welfare of the economy. Now, this is basically it. This is, that's the, in a simplest possible way one can talk about general equilibrium theory. And it's the metaphor for, the clearance is, coordinating act of price mechanism is your rocking horse. So the general equilibrium model, older generation of general equilibrium models were improved for policy analysis in what is called this computable general equilibrium model. And they looked at, they talked about in this new class of dynamic stochastic models, you give shocks, policy shocks, like policy shocks. If you have, interest rate targeting at a certain level, what happens? So you basically still assume that the economy, suppose it's somewhere here in this growth path, and there is apply a shock here, some policy shock, interest rate shock, inflation targeting shock, or whatever shock, monetary policy or fiscal policy shock, and it goes back, and you basically look at how long it takes for the economy to come back to its original position of rest. Now, so this whole idea that the economy itself is an equilibrating process is fundamental too, and that's exactly what that man did, in Irish economist who did is, is squeezed the sponge and said that it'll come back to its original shape after some time. So growth will happen when you after a while, and how long it takes to come back to its original position of rest and so on is what the policy scenarios that they do with the dynamic stochastic general equilibrium model. You will see a lot of policy shocks and the simulations, these kind of graphs in this in the DSG papers that you'll see. Okay, and one of the important things about the characterization that I've made here of general equilibrium theory is that there is no money. Money is another commodity. Money doesn't matter here. Money does not enter at all here. So money could be anything, right? So it could be a some agreed commodity. Okay, it's another commodity is money. So the neutrality of money. So whatever happens in the economy is independent of money. Money does not have any role to play in the determination of output and employment and so on. It doesn't have a say. All that money does is that it influences inflation, okay, or it determines inflation. So if too many goods are chased by too less money supply determined by the central bank, then obviously you'll have inflation. If too much money supplied more than the commodities being produced in the economy, of course you will have deflation. So money issued by the central bank, the monetary authority, it's basically a commodity that basically comes between commodities, the medium of exchange. The only role is both the unit of account and the medium of exchange. It does nothing else. So this is called this neutrality of money, or classical dichotomy. So money is neutral. Okay, that is quite fundamental to the neoclassical or the general equilibrium models. So the real business cycle. So business cycle fluctuations. So how am I supposed to explain these fluctuations in output and employment? Of course, it's a real phenomenon. That's why they're called real business cycle. One of the models. These are basically the fluctuations arise from frictions in the market. So it could be like Mankiw's model was called the menu cost models. So menu cost models is that, well, you can't print menus every day. Okay, menu cost models is that you can't print menu cards every day. There is, you can't change the price as often as you would like to do. So that creates a friction in the market, and in turn creates fluctuations in output. So any friction, so the frictions and rigidities that you have in the markets can create fluctuations in the market. And then after a while, if you remove these fluctuations, the assumption is that the market will come back to its original level or original position of rest. So the DSG models came out of that real business cycle models, okay, in the literature. They got the Nobel Prize for Kudlin and Prescott got the Nobel Prize for this. The assumptions at the micro level, as I discussed in this general equilibrium model, you have the optimal trade-off between labor and leisure. That is absolutely fundamental. Now that is quite absolutely fundamental at an individual level. So in the second generation of these model, DSG models, to make it dynamic, the trade-off is intertemporal trade-off between present consumption and future consumption. That's where the expectation comes in. Okay, in order to smooth your consumption pattern, your expectations should be in such a way that you maximize your utility. So this individual level behavioral trade-off is fundamental to DSG models. And economists working with these models recommend economic policies that would not distort these trade-offs. The trade-off is sacrosanct. You cannot, anything that distorts this trade-off is a problem, an issue. So fiscal, monetary, structural policies must minimize, these intertemporal distortions. So in a way, the metaphor of rocking horse became a reality or turned into a reality, and in that process, it is a belief system. Okay? It is a belief now. It believed that the economy is a equilibrating process. And minimizing this is quite, as you can see in the past history, in terms of practical policy, you'll see that they require three simple requirements. The tax rates on labor and consumption should be roughly constant over time. Capital income taxes should be roughly zero. And the returns on government expenditure and the operational costs of assets should fluctuate so as to balance the government's budget at present value cents. So you have to, the present value of government budget deficit should be balanced at each point in time. That's the intertemporal optimization of fiscal deficit. And if you look at the effective marginal tax rates in the US, from 53 to, on capital income from 53 to 2003, you can see a massive reduction in taxes, marginal taxes on capital income. And I've given the source of this. So we have seen that from expansionary stimulus to expansionary austerity. So it is diametrically opposite position you have from 1940s. And what is the context to this? Where does this come from? Okay, so that's the story of macroeconomic theory. That you have the, if you want to say that the story is your roaring 20s, that's a laissez-faire free market economy. After the Depression, you have a change. The Keynesian revolution started, and the policies were informed by the Keynesian revolution, and the golden age of capitalism, well, it had a different history, the military history and so on, but still that period underpinned by so-called Keynesian revolution, it's called the golden age of capitalism. And then you have the counter-revolution in the 70s during what is called the stagflation. You have massive stagnation of output and inflation at the same time, which is called the stagflation in the 70s. So monetarists, the counter-attacked Keynesian revolution and said that, well, Keynes is wrong, you can't do this. It doesn't work. Keynesian economics doesn't work anymore. And then Robert Lucas, the rational expectation and the efficient market hypothesis, which is famous in the financial literature, 1980 onwards, and you had roaring 90s, it's called the period of great moderation up to the crash, 2008. This story, you'll see Gary will talk about the story in a different way with an institutional context. And people like many of the macroeconomists, they'll tell the story in many different ways. But the broad brush of the macro story is simply this. What you can get from the story is that you have a diametrically opposite position right now in terms of the same institution, IMF, which actually argued for counter-cyclical stabilization policies, now is turned into a pro-cyclical policy. Pro-cyclical, again, I will say stabilization policy, which is interesting in itself to understand the history of how this change has come about. And without a theoretical underpinning, theoretical change in the theoretical underpinning, this change, it's very difficult to see how this change would have come about. And that's what I'm trying to trace. What is the change in theory that actually impacted these institutions, policy stance of these institutions. Now, so you can clearly see that 1920s or the 30s, Great Depression replaced the event Great Depression, replaced the existing economic orthodoxy into by a Keynesian economics, let's say Keynesian revolution. The stagflation of the 70s, the event on the sequence of events since the 70s replaced the Keynesian economics orthodoxy with monetarist economics. But we don't see such a shift in this crisis. Okay, what we see is that a kind of consolidation of the existing monetarist prescriptions, monetarist orthodoxy in this crisis, which itself is an interesting question. Say why, existing the prescription that actually led to the recipes that actually led to the crisis became the remedies for the crisis, became being articulated as the remedies for the crisis. Why is it so? That itself is a very interesting argument to understand. Now, you can see that the evolution of macro theory, as we saw from general theory, 1936, the Keynesian economics. Immediately after Keynes wrote the book, 1936, there was an article in 1937 by Sir John Hicks, British economist. He interpreted general theory. By way of interpreting, he gave a model called ISLM model. Okay, I stands for investment savings / LM is the liquidity preference theory model. So it's an interpretation of general theory. Now how this interpretation came, it had a profound impact immediately on the profession. Not so immediately, but in a little while. So ISLM was not only, it became a pedagogic device for teaching macroeconomics around the world. I mean, even now, the textbooks have the ISLM model. It also influenced economic policy making because it's such a simple model to understand this terrible book. It's not terrible, it's a very hard book to read, Keynes's book. I mean, general theory is a very, very hard book to read, particularly chapter 2. If anybody reads the chapter through without having a fight with somebody, I can salute you, because I had massive fights with my friends in JNU. I didn't speak to one guy for 3 months for one sentence. We interpreted differently and we didn't agree that sentence can be interpreted that way, and we didn't talk to each other for 3 months. It's very terse. That book is very terse. And ISLM model was amazing. It's very, very simple, so easy to understand, and everybody used it, and it became a pedagogic success as well as it influenced. You can clearly see the impact of fiscal policy, monetary policy, and all that. So the ISLM became kind of a model to study the effects of stabilization policies, of fine-tuning. So what happens if fiscal policy is changed a bit, and what happens monetary policy is contracted, what happens to interest rate, what happens to output. So if the government wants to fix the interest rate but change the output, how can I do it? Or if the government wants to change the output but fix the interest rate, how am I supposed to do? What kind of mix that I use? All this, all this kind of debate that happen. You have cold turkey versus gradualism. You want to reduce the interest rate in a drastic way, or do you want to reduce the interest rate in a more gradual manner, or increase the interest rate in a drastic way or a gradual way? All that. It all depends on, again, these two curves. This is the IS curve, and this is the LM curve. And this comes from basically general theory. So I'll just explain a little bit of where this comes from in terms of general theory. So one of the main, the contention that John Maynard Keynes had against the neoclassical general equilibrium theory, or what he called as classical economics, is that, well, he asked the question, well, this doesn't work. This cannot work. The savings automatically leading to investment is nonsense. Okay, the first line of attack was, okay, he said, well, what he yielded to was what is called this fallacy of composition. He says, well, at an individual level, if I decide to save today, okay, if I decide not to have dinner tonight, and I'm going to use that money to have treat myself next Friday. So the amount of employment that is lost because you decided to save today, decide not to spend today, will be somehow created next Tuesday or next Friday when you start having. So at an individual level, there is absolutely no problem. But why should it apply at the aggregate level, at the macro level? That's what he started. Because the assumption is both the savings and investment are simply determined by interest rates, right? So decide to save, that decision is based on today's interest rate, and investment also is. So interest rate is the mechanism or the price of this banking sector is coordinating the savings. He said, no, nothing doing. It doesn't work that way. What applies at an individual level need not apply at a macro level, because investment is determined not only by interest rate, but also something called animal spirits. So what he yielded to was, well, when you are beginning to invest, when you want to thinking of investment, you want to invest in Pizza Hut, or you want to invest in beer factory, or you want to invest in some other thing, you calculate the prospective yields that rise in these prospective yields. You don't know exactly what you're going to get because you don't know the size of the market. So how do you know when you start when you put a something in your Facebook, how do you know how many likes you will get? You have no idea. You don't know the size of the market. So size of the market depends on the the demand that exists in the economy. Okay. So the investment is not just determined by your interest rate, but something called animal spirits, or the prospective yields, or the prospective yields itself is determined by expectations about future. So we do not have a general theory of expectations. How do you know how people make expectations? And that's where he yields to this beauty contest. So he says that the calculation of prospective yield is something like 6 judges sitting and judging the as he says 6 prettiest faces, the prettiest face out of all the contestants. So he says, well, there is no objective beauty. So each of the judge will be chasing the average opinion of what the average thinks who the prettiest face is. So everybody will try to come some kind of averaging. They chase average of the average of the average. He says we have come to this 3rd degree of chasing the average of what the average thinks of which is the prettiest face among the competitors. So investment, the investment is determined by so-called animal spirits, as he defines the action, innate urge to action rather than inaction, that determined by something like a prospective yield expectation calculation. And there is no guarantee that this investment, whatever is being saved in the banking sector, automatically will lead to investment. Back in the circular flow, and it is this disconnect between savings and investment that can create aggregate demand unemployment issue. So what he does is that he starts from that and says that, well, investment, for prospective calculations, you need interest rate, because you have a cost of capital and your prospective yield. You'll compare and say, well, the cost of capital is much higher than the prospective yield. I'm not going to go into this particular firm. I'll go into some other business where the cost of capital is much lower than the prospective yield. So you need interest rate for that. So where do you get interest rate? So interest rate for him is determined in the money market. Okay, so what is that? So how do you determine interest rate? So interest rate is determined by money demand and money supply. If you assume that money supply is given by central bank, but money demand, so what is the theory of money demand? So what drives you to hold cash in your pocket? That's the liquidity preference theory that he started. He says, well, the money demand is determined by what is the return that you get. Let's say if you have 2 assets. One is the cash that you hold in your pocket, and one is the bond that is issued by RBI, treasury bond that is issued by the government, let's say. So the amount of money that you would like to hold in your cash, if the treasury bond is very attractive, it gives you very good return, you would not hold much cash in your pocket. You'll put it, because you're losing money by holding cash in your pocket. The opportunity cost of putting cash in your pocket, you're losing it. So you put it in the bond, right? But if the rate of return on the bond is lower, then you would just keep it in your pocket. So money demand and money supply will determine your interest rate, and that interest rate will determine your investment, and that investment will determine your output and employment. So he inverted this whole process. He starts from the money. It's basically a monetary theory of production. You start from money. You start from money demand and money supply, which determines your interest rate, which again gives you the investment schedule, and then it gives you the output. So it's starting from money to output. So in a sense, you're talking about a monetary theory of production. Okay, so this was the story. So for him, the blocks were the liquidity preference theory, which is this LM schedule. This LM schedule of the caricatured LM schedule of the ISLM is the liquidity preference theory. Liquidity preference theory. It's a good book to read. It's available online, free. Liquidity preference theory, the general theory. And then you have the the investment theory of investment based on expectations, and then you are the how investment determines output through a multiplier process is the famous multiplier relation, and that's so it's a kind of it's a monetary theory of production. That's where this is the simplest possible way I can think of introducing Keynes. I may not have done full justice introducing Keynes, but this is the crux of the issue, at least as far as you can get. So you will say that, well, the policy is that what? It doesn't work. Okay, it doesn't work. So this automatic translation of savings to investment need not work. So what do? That amount of what is not being translated into the market has to be funded by the government. Okay, because every unit of investment that you make, every unit of expenditure that you make, creates multiple times of output, and that creates employment. And that employment creates demand in the economy, which makes the realization of profit work. Because when the prospective yield calculation, it's a prospective profits. It's only potential profits. Okay, that the realized profit you can only realize by actually selling it, right? And the selling it, you need demand in the market. That is the crux of. So you need fine tuning of fiscal and monetary policies in order to create. The market it won't automatically translate at an aggregate level. So you need the fiscal and monetary policies to fine tune this to create the welfare. In fact, he's not saying anything against market. He says the inherent capacity of the market to equilibrate does not work all the time. So you need government support through expenditure policy and monetary policy. Okay, so it had a massive impact. That's why it's called Keynesian revolution. And the long-standing building block of IMF policy advice is a version of the monetary approach to balance of payments by Jacques Polak, deputy director of IMF in 1950s. Polak's monetary model emphasized the effect of fiscal policies and credit creation on balance of payments, working primarily through a Keynesian multiplier process. So in a classic situation, what the model argued, IMF's model argued, the country with a fixed or a managed exchange rate and an external payments deficit can resolve its imbalance by reducing domestic credit of their banking system by either fiscal or monetary. Again, you'll see the entire everything is around this fiscal and monetary means, policy means, stabilization means. So this was Keynes, right? This was the Keynesian revolution and so on. If you read general theory, you will see that one of the assumptions that he makes in the initial chapters is that the price, there is no theory of price. It comes much later at the end of the book. Now, this was the problem in the 70s. So when you use Keynesian economics, general theory, to understand stagnation in output and inflation, sudden inflation. How am I supposed to understand this event through Keynesian economics or Keynes's general theory or Keynesian economics in general? So it was argued that Keynesian theory lacked a price. Okay, so just before 70s, there was in 1954, there was a British author called A.W. Phillips, British economist. Well, it was an engineer turned an economist. He worked on a very simple worked on British data to look at the relationship between money wages and unemployment. Okay. Now, quickly, the Keynesians at the time, Robert Solow, Samuelson, they modified Lipsey, Richard Lipsey, Robert Solow, Paul Samuelson. They used that. It was basically he found an inverse relationship between money wages, rate of change in money wages, or percentage change in money wages to unemployment. Okay, the data was, it was an empirical work. It was a kind of empirical relationship that he found between money wages and unemployment. That was quickly used by the Keynesians then to argue that, well, if you actually use the price, if you think of price formation in the firm as as based on cost plus pricing. So price is based on some kind of markup on the cost, let's say variable cost, okay, which is basically labor plus other operational costs. If you use this kind of a price relation, which came from Michael Kileski, is one of the pioneers, one of the unsung heroes in macroeconomics. That's a different story. I won't get into it. But if you ever get a chance to read Michael Kileski's, even the letters that Michael Kileski wrote to this group called Circus in Cambridge of Keynes and the group, it's very fascinating. He's the unsung hero of he should have been the hero of macroeconomics. Anyway, that's a different story. Now, if you have this kind of a price relation, which is he argued that Michael Kileski argued there are two sets of prices. One, the price that happens in perishable commodities like tomatoes and potatoes. Of course, it is demand driven, demand and supply driven. That's fine. But non-perishables, you need not have the same thing. It's based on markup. It's based on brand equity, based on the market power that you have. Apple can set whatever price they want, okay, and that's their market power. Microsoft can set whatever price they want. It's based on the market power, and that is determined by your markup. Okay, that market power gives you this markup over and above the variable operating cost that you have so this is a cost plus pricing. If you use this kind of a framework, if you assume that the firms are using this kind of framework, the Phillips curve, what is called as Phillips curve later, is simply you can convert this into a rate of change in price and unemployment. So this gave, and this is nothing but inflation. The rate of change in prices is inflation. This actually gave a nice menu for policymakers, that there is a trade-off between inflation and unemployment. So if you want to reduce your unemployment, so this is unemployment. If you want to reduce your unemployment, you have to withstand this much of inflation. Okay, there's no other way. This is a trade-off. You can't do it. So now this became the kind of policy. What kind of what kind of trade-off that you want to set? How much unemployment that you can reduce, how much inflation that you can bear, and so on and so forth. Now, so they, in a sense, they gave a closure to Keynesian or Keynes' general theory. So Keynes' general theory had interest rate investment output, okay, but there's no prices. So this equation gave the closure to the model. So you can determine output, and the same model, in the same model you can determine prices. So both prices and output are determined in the same model, which gave a closure to the Keynes' general theory. Now, the same thing was exactly used by Friedman. Milton Friedman, what he did was, he said this, okay, if this is what you're doing, okay, there is absolutely, when he says when wage negotiations go on, so one of the assumptions that Keynes has is that it's a contractual economy, right? You go for wage negotiations with your employer. Now, Friedman argued that when you go for wage negotiations, you also take into account the expected inflation into account, okay, expected real wage. You can't negotiate based on current, inflation. You will say, okay, tomorrow inflation might rise, so I need to take that into account. So in your wage negotiations, expectations come into play. That basically means that he says that, well, if the government decides to do expansionary fiscal policy or monetary policy, okay, so it's going to increase output. That means it's going to reduce unemployment. So suppose your economy is here, you increase your expansionary fiscal policy and monetary policy, your output increases, so unemployment falls to this level, let's say U0 or U1, okay? At that level of unemployment, the actual inflation is here, okay, say pi 1, okay? Now, what would the workers think? Workers think, oh, the inflation, actual inflation has risen from, let's say, pi 0 to pi 1. So say you start from here, U0 to U1, U0 was some pi 0. Suddenly, the actual inflation has risen. So I'm going to negotiate with my employer that since the actual inflation is risen, the expected inflation might go high. So I need to increase my wages. Real wages should be increased. So he will demand. If he doesn't get, he's going to shrink that much amount of employment, giving to the market. So he will, finally the economy will come back to this position, long run position of unemployment. So they will revise the expectations every time when there is a small rise in actual inflation. So the economy will come back to its original position of this long run unemployment. And this was called as the natural rate of unemployment. So he basically argued, Friedman argued, the only mistake, one of the mistakes that Keynes makes is that the agents are not adaptive. They're not expectational agents. They're not adapting to the inflation, changes in actual inflation. If you actually assume the agents are adaptive, for every change in actual inflation, they revise their expectations. That revision of expectation will bring back the economy to its long-run position. He says, well, I agree that in the short run, Keynes is right. In the short run, you will have the expansionary fiscal and monetary policies will have an impact. They will reduce output, they will reduce unemployment, and so on and so forth. But in the long run, the economy will come back to its original position of rest called the natural rate of unemployment, okay, NRE. Now, unemployment, natural rate of unemployment. So this is something like a 5% or 6%. So the profession went on to estimating the shifts in the Phillips curve. So from 70s onwards, 70s onwards, the lecture was in 1969 and 70s, you will see shifting Phillips curve, and there's a lot of work went into a shifting Phillips curve and proving this natural rate of unemployment to be some 5.3% or whatever in real economy situation. So this is its NRU, natural rate of unemployment. Now comes, so this is in the long run, policy is ineffective, right? In the short run, it is effective. Yes, policies will be effective, but in the long run, you're back again to this long run position. So there's a long run ineffectiveness of monetary and fiscal policy. So the economy will be back to its natural rate of unemployment. You can do nothing about it, okay? So this is called the expectation augmented Phillips curve. They modified the Phillips curve argument to put in expectations, and it is famously called as Friedman and Phelps. Phelps, who won the Nobel Prize in 2007, and they both worked on this and they got this. So then came the next improvisation, the rational expectation school, or Monetarism Mark II, which argued, why do you think adaptive? Why can't you think these guys are rational? The basic argument, even when the policy is announced, you and I know what will be the effect of the policy, right? If the interest rate is going to be raised by the Fed, by FOMC, say 2 o'clock they announce, I immediately know what is going to happen. So I will not change my position. The economy is always stuck at the natural rate of unemployment. That was the argument of the rational expectation argument, or the Neoclassical macroeconomics. That is so the economy would not even move, because I will adjust my supply decisions. I will not even bother to give more labor to the market, because I know what's going to happen. At the end of the day, when they increase, let's say lower the interest rate, well, it's going to create inflation, and it's going to cut my real wages. So I'm not going to give the labor to market. I know what's going to happen. So even if you make errors in judgment, that on an average, that errors form a kind of a normal distribution, have a zero mean. There is no systematic errors in agents making expectation calculations about what might happen as soon as the policy is being announced. Okay, so there is an anticipation of expectations, and as soon as the policy is announced, I know what's going to happen. So Robert Lucas further argued, how should policy be set today? He said that kind of question is ill-posed, because people's current decisions depend on their expectations of what future policies will be. And these expectations depend in part on how people expect policymakers to behave, right? So what he argued is that the monetary authority, on the other hand, monetary authority cannot predict how economy will respond to policy decision today, unless it can also predict how people's expectations of future monetary policy will change, right, as a result of current decision. Also, monetary authority also needs to figure out how its own behavior will change. Today I'm increasing my interest rate. FOMC has increased its interest rate. it needs to predict how its own behavior will change given the institutional and political pressures on the current action. So with these concerns on the impact of expectations, Lucas argued we need a coherent framework for the design of economic policy, and it must consist at least a model to predict how people will behave under alternative policies, a welfare criterion to rank outcomes of alternative policies, a description of how policies will be set in the future to avoid time inconsistency problem. So basically what it led, in short, the policy ineffectiveness paradigm is basically the autonomy of central bank. It basically took this monetary policy making away from any kind of interference of discretions, political discretions. Because when you say a policy, you have to be consistent. You have to stick to that policy. You cannot renege on that policy because it affects expectations. Today, a politician comes and says interest rate will rise, and tomorrow it says no, interest rate will be dropped. That creates confusion and chaos in the economy, and there's an immense cost of dealing with that kind of expectational errors. No, the implication of this theory and the policy ineffectiveness in the short run, including in the short run, basically led to the autonomy of central bank. Okay, so you'll see the rule-based policymaking came into vogue since the 80s. The Taylor's rule is famously used everywhere, inflation and interest rate targeting. They moved from inflation targeting to interest rate targeting. Everything is well set. There is a group of, it's basically with the central bank. It's a technical expertise which actually deals with monetary policy. Starting from New Zealand to Australia to ECB, Bank of England, everywhere, it's a rule-based policymaking. In a sense that, yeah. The surprise, I don't know how it varies from central bank to central bank. This ECB does not like any surprises. The rule is set, it's a rule-based policy making. So now they have improved that rule by saying there is a band. So if the inflation, moves from its, let's say, natural rate, for simplicity, natural rate or target rate, then there is an automatic adjustment that takes place within the monetary policy or within the system. Okay, so I don't know how they deal with the surprise shocks is I think it's left to the independent central banks. Not it depends on central bank to central bank. Yeah, I read about that. Yeah. Gary might have something to say on the ECB and the Bank of England. I don't think we have that kind of surprise because you are beating the market kind of logic there with the RBI. I don't think it's very well accepted, very well received, given the kind of situation that we are in Europe and in the US. I don't think market will kindly take anything of that kind of a move that central bank governor comes and says that, look, I'm going to. So the whole point was not to have any discretions. You have to stick to your policies. You can't have. Yeah, it's an interesting point. I think Gary might pick it up. Yeah. Yeah. It's the Taylor's rule itself has improved, quite a bit of improvement done on the Taylor's rule. They now use some kind of stochastic shocks in the equation itself in targeting. So they do take into these kind of the unanticipated shocks are taken care by this. But the interest rate change, I don't think it happens because of the shock. I think once you say the interest rate will rise by basis points, that's it. I don't think till the next FOMC meeting or next meeting, I don't think interest rate changes. It's a huge cost to the economy. I think that's the way it goes. I think we should take a break. Is that the, yeah. Okay, I'll continue. We'll take a break. What's the 15 minutes? Yeah, coffee is outside, and coffee is outside. Yeah. Okay, so we'll continue this. I think I had interesting conversations with few of you, and Hani Karun has a interesting result on the new Keynesian Phillips curve that he's going to present that poster. He has actually estimated for Indian economy and showed a convex shape, and he says that the output gap is actually significant at a stagflationary regime. Is that correct? Yeah. So the poster he'll present, and we can pick up this conversation there at the poster session as well. Posters will be there throughout the winter school that we can. Okay, so we talked about this as the rule-based policymaking, Taylor's rule, modified the new consensus rule, and so on. Not just the monetary policy. Okay, since the 1990s, the academic research under the monetarist orthodoxy, it actually reshaped and re-articulated, reshaped the institutions that govern decision-making over public finances. So all the research and the implications of those research came to fruition because in this crisis, you saw the limits to monetary policy. You already have a zero interest rate and in Europe, and very close to zero till now in the US. So you needed something else to prop up the economy. It's not enough that monetary policy, you needed fiscal. But fiscal policy is in the hands of discretionary policymakers. You can't rely. So you wanted, what ECB had done and is doing right now in Europe is the ex ante rules, such as constitutional limits on deficits. It's still not come into play, constitutional limits, but they're moving towards it, and procedural rules for the budget process, and the rule-based fiscal policy to minimize political distortions. So, in fact, I had it somewhere. I wanted to show you the quote of. So if you see this exact quote of the Maastricht Treaty, this is 10 years of ECB document, which basically talked about, can you see this? So I don't know which one to, yeah, this one. So this is the 10-year document on 10 years of European Central Bank. The framework was basically articulated this way. The Maastricht Treaty foresees 3 different modes of policymaking in the various fields of EMU, European Monetary Union. Full transfer of competence to the community level for monetary policy, rule-based coordination of fiscal policy, soft coordination of other economic policies. So this is very, very clear in terms of the way, at least in Europe, the way things are moving in that direction of, yeah. Community is individual countries. So it's like coordination between different central banks. So, okay. So basically, you're not just monetary policy, you're also pulling the fiscal policy in the gambit of the rule-based and completely removing any political interference into the decisions of fiscal policy. Now, the recent experience shows that the expansionary fiscal policy, as we see in Europe, that is, which is nothing but the whole thing of by raising the expected future disposable income for households and thereby increasing the confidence of investors, fiscal consolidation can thus stimulate private consumption and investment even in the short run. Has clearly failed in terms of Europe. You have Europe and in the US. US is still slowly coming back into growth. So this unreasonable effectiveness of the austerity policies on the real economy can be clearly seen in the US and Europe, in terms of its impact on output and employment. The classic figure that comes to mind, which is often used even by Krugman and so on, you can see percentage losses after post-World War II recessions. This is the current recession. This dotted line, or this red line, the thick red line is the current. So from 1948 to various recessions, and this is the 2007 recession. From its, this is the percentage job losses relative to the peak of employment level. How much is the loss and how long it takes to get back into the previous level. This was seriously a severe recession that we have. So the austerity policies in the 6 years have even compressed the level of activity, and it takes a longer time for the economy, even in their own, the framework of equilibrating framework, it takes a longer time to come back to the natural rate of unemployment, for instance. Yeah. This is the US one. Okay. So, So the severity of the austerity policies in the aftermath of the crisis, it's clearly pushed European economies into what now people are calling as a secular stagnation. Stiglitz called it, and many of the economists now recognize that it's a long-term recession or a secular stagnation. One of the fundamental reasons for this, for the state we are in now, the failure of policy and lack of ability to get back the economy into its growth path, is a flawed description of the crisis, which comes from the lack of historical and institutional context and detail in the models, such as the policy models, such as the DSG models used by the policymakers. Now, this is quite important because these models lack the context, historical context. So what is the historical context? Let's see the historical context since the 80s. Since the 80s, you will see this is the stock of financial assets from 1980 to 2007. So on the y-axis left side, you have the multiples of world GDP, and on the x-axis on the right side, you have the nominal figure. From 80 onwards, you'll see the US, particularly in the US, the growth of the stock of global financial assets. This is a global financial assets in US dollars, sorry. So that is about multiples of 4.5 times of world GDP that has grown. And the source is given at the bottom, the IMF and the the McKinsey data. This is the first one. The next, where is it? And you have not just the stock, but also you have the financial deepening. The ratio of financial assets to GDP also grown tremendously in this period, 2002 to 2007. And 2002 is in the white bar and 2007 in the blue bar. So US, Germany, and Sweden on their ratio of financial assets to GDP, and Spain, Greece, Portugal, and Ireland. Asia, Latin America, Middle East, Africa, and Eastern Europe. So you can see this is an interesting graph by itself. I mean, I'm not getting into the details of it, but you can see the patterns that emerging since 2000 in terms of financial deepening. This actually says, if you look at the European economies like Spain, Greece, Portugal, and Ireland, this actually says a story about the European crisis that we have. Okay? It's a different kind of story that's been told by the mainstream. And the annual real rate of growth of the stock of financial assets and GDP, you can clearly see that follows the similar trend. So massive explosion in terms of financial assets. And even more starkly, you see in the US, the total financial assets and private investment is the gross capital formation, the real tangible capital and the financial assets. You can see the divergence after 1980s. So the financial assets, or the total financial assets of all sectors, and the private investment is the real tangible assets. So you can see from after 80 onwards, this is popularly known as the Tobin's Q. Tobin's Q is the market value of tangible assets or the replacement cost of tangible assets. So it's the growth is skewed towards the financial assets. And if you look at can you see this? Yeah? So the financial assets as a percentage of tangible assets. That also clear growth from 80 onwards, sudden exponential growth after 80. 1980 kind of, clearly marks a, different era from the previous era. This is the financial asset as a percentage of tangible assets, and the source is the flow of funds tables in the US. This is all in the US context. And in the financial assets, the financial income, if you look at the financial income, is basically driven by the interest and dividends. Okay, interest and dividend income as a percentage of internal funds of non-financial corporations like auto industry and non-financial corporations from 1952 to 2003. So it tells you a story of, where does the internal funds, retained profits, come from, the proportion of interest rate and dividends, or the rentier income, as they say, in terms of the retained internal funds or retained profits in these, even in the non-financial corporations. The total financial payments as a percentage of profits before tax. That's again, it gives you a picture of what is happening between the financial income and the real, I call it real income from commodity production. So what I'm trying to argue here is there's a plenty of evidence in the literature to show the capital formation, the real capital formation that we know, as well as the financial income that comes from holding financial assets. There is a wide disparity. And these are all evidence to show that, well, that's going on, and you can clearly see the levels are quite different. If you even further analyze, you'll see, even though there are fluctuations, you'll see from 80 onwards there is a marked change in terms of what is the source of, if you take it at different levels of description if you take the balance sheet of a non-financial corporation, and you can actually figure out what is going on, where does the income, what is the retained profit, and what is the proportion of interest and dividend payments arising from holding financial assets in their balance sheet. This is the share of financial corporate business in corporate business before tax. So the share of financial corporate to the corporate. So share of those like Goldman Sachs, this is a financial corporate business in total corporate business before tax. That profit as a percentage. So that has tremendously increased. And this is all in the US context. I don't have the data in the Indian context. Yeah, the profit is, the assets minus liabilities, the net worth. Yeah, that has been discounted. All this has been discounted. Yeah. Like Google, for instance, is actually based in Ireland. Now it's producing from Ireland, but headquarters in, say, the US and so on. I don't know how the Cayman Island stuff works. I don't know that. But as far as Ireland, these kind of Cayman Island is I don't know where it is a special purpose vehicle, or I don't know. Yeah, as far as Ireland is concerned, the profits that has been recorded in Ireland, because the tax rate, the corporate tax rate, is very low. That is accounted for, not the other one. This figure shows the share of financial corporate business in corporate business after tax profit as a percentage. Even after tax, you still have, that actually takes care of your questions in terms of, there are places where they locate. There are tax havens where they can actually locate and recycle the profit. So the back office countries, operations, Ireland is a big operational base for all the financial corporates. Ireland, here we have in Hyderabad or Bangalore, Jamaica is one place, and Singapore is another place. There are a few places around the world that you have this back office operations, and the tax regime is kind of lenient and low. And this is the division, disparity between profit rate, after tax profit rate, and the capital accumulation, rate of capital accumulation. Okay, and the blue line is the blue line is the after-tax profit rate, and this is your rate of capital accumulation. That's the rate of change of real net capital stock, taking into account inventories and depreciation from 48 to 2007. This is a very interesting figure that you can see after 80s again. The correlation is kind of lost. Accumulation declined, but the profit rate, after-tax profit rate, kind of increased. And in terms of incomes, and this is from Piketty Sauce, and Piketty, Alvarado, and the Atkinson group, all the data. So they have this very interesting website now, top income. There is a nice website they have in terms of top income database. Yes, that's the database that you have, and they're going to put yeah, this is the one. So top income database, and it has a lot of data on various countries. It has data for the things on maroon is they have the data, and rest of the countries they don't have the data. It's a very, very, very exciting website. They're still developing and so on. So the next set of slides will come from that database. You can go and actually download the data and look up the data. So the average income growth in the US, so average income growth in the US in terms of income groups, you can see from 1993 to 2000 and 2002 to 2006. So white is in that 1993 to 2000, and blue is the 2002 to 2006. So you can see the 99 to 100 percentile, their income, the change is 10.3% and 11%, whereas the bottom 0 to 90 percentile, the income growth in 2002 to 2006 is actually 0.3%. Okay, and then if you look at the, yeah, yes. And then you have the average income of top 0.1% and the bottom 90% from 78 to 2006. And you can actually look at the rate of changes as well. The slopes gives you the rate of change. Bottom 90%, the rate of change, the relative rates of change is quite interesting to see how fast the increase is and so on. It includes capital gains as well from 1994 to 2000 and 2002 to 2006. Again, it's all from the Piketty Sauce work. And they also documented the top 1% in different countries. UK and US is quite stark. It says amazing trend in UK and US in terms of the top 0.1% share in national income. And this is UK is in the rectangle and US is in the square. And then you have this is, Piketty goes after this kind of data quite an exciting work. So the data sets are there, very clearly articulated, and it clearly shows the personal income distribution patterns. And again, in terms of France, Italy, and Portugal, in percentages, the top 1% income as a share of national income, you can see. Whereas in US and UK, it was increasing. Here it was it's increasing not to the same extent from the 80s. We're only talking about 80s is called the kind of financialization phase, or where non-financial corporate business got heavily involved into financial assets and financial markets. Again, in Ireland and Spain, well, the similar story continues, but the levels are different in terms of the top 0.1%. And if you look at the functional distribution of income, and this work, it's an interesting work by Stockhammer Group in UK, in Kingston. They looked at adjusted wage share in advanced countries, share of wages. So you have share of wages is nothing but your wages, the wage bill divided by the national income. adjusted for self-employment and so on. So the adjusted wage in advanced countries like Germany, USA, and Japan from 1970 to 2010, you can clearly see the advanced countries, which is the blue line, the trend is going down. And then you have Japan, USA, and Germany. So the average as well as the individual countries, you can see the growth or the growth in the wage share is basically declining. Okay, and if you actually tie this with the Piketty-Sauce personal distribution of income, so if you look at the, let's say, bottom 90% or bottom 60% or even bottom 40%, the way he does, even in that you can actually figure out the income from employment and income from financial, or the financial income. We'll call this real income and financial income. That proportion is heavily skewed towards financial income. Across the personal, this personal levels may be different, but you can clearly see the way the total income, the skewness towards the financial income goes across various distributional classes. Size, if you take in terms of size distribution, if you take in terms of personal distribution, or in terms of wage distribution, as these guys have shown, there is a clear pattern that is emerging since the 80s. And developing countries, it's a kind of a similar story of wage share is declining. Okay, so DVP3 is the unweighted average of Mexico, South Korea, and Turkey. DVP5, developing countries 5, is a group of 5, unweighted average of China, Kenya, Mexico, South Korea, and Turkey. And DVP16 is the unweighted average of 16 countries: Argentina, Brazil, Chile, China, Costa Rica, Kenya, Mexico, Namibia, Oman, Panama, Peru, Russia, South Africa, South Korea, Thailand, and Turkey. Yeah? Yeah. I don't have the data for Scandinavian countries, yeah. Yeah, I know what you mean, yeah. The Scandinavian countries show, I mean, Sweden actually show a very different picture than what we saw in terms of top 1 percentile. So wage share, I don't know. Yeah, I look up for that. It's not difficult to get it. So it should be. I don't know. Yeah, I don't know the surge, why the surge happened in the 80s, mid-80s. These are all weighted average, many countries, so I don't know the historic details, what happened in those countries. But I'm taking this as to show as an evidence, at least as a statistical evidence, as you can see, that the wage share, the general trend is declining. Okay, the individual, tranches, I mean, that part which is rising is, I don't know, which the reference is in the end of the slide, so you can look up whether they talk about, I don't think they talk about the historic details about what happened in that phase and so on. Okay, so they also, the same group, Stockhammer, this was an ILO document, International Labour Organization document. They talk about the contributions to the change in the wage share. What actually contributes to change in wage share for advanced countries in this time period, 80 to 2004? They have 4 set of indicators. One is the financialization, that is the ratio of financial assets to real income, financial income to real income, and globalization and technology and welfare state. What is the withdrawal of state subsidies and so on and so forth. So they do see that this is an econometric estimation based on the data sets that they have on these individual countries. It's there in the document. You can look for it. The financialization actually contributes relatively more to the change in wage share vis-a-vis the other indicators like globalization, technology, and welfare state. Now, if you look at for developing countries, technology has positively impacted change in wage share. By developing country, they mean the three groups of countries, 5, 7, and 12. And financialization negatively impacted, globalization negatively impacted, and the retrenching or retraction of welfare state has negatively impacted in the change in wage share. This is, I mean, there is a lot of work going on in this direction in ILO and so on. If you take all countries, if you take an average of all countries, the contribution to change in wage share, both developing and developed countries, financialization stands out. Financialization, that is the financial income that is coming out of investing in financial assets. And so globalization to some extent, casualization of labor, and so on and so forth. Technology actually positively impacts, that comes from the 17 countries result, and the welfare state, the withdrawal of welfare state, that increase the precariousness of working condition and the contractual obligations and so on and so forth. So they neatly summarize it's a very good document to read. Okay, it's a Stockhammer group. They have been working on this for quite some time on wage-led growth, wage share, and so on, how wage share is impacted. So this is, you have this. So let's summarize, what we actually see in the literature. Okay, the first is profit share. You have the share of profit. So if you want to see this, so you can want to say what is profit share, and so this is your national income is profits plus wages. Okay, so if you divide, so this is your profit share and this is your wage share. Okay, let's call this H, and so this is 1 minus of. So this is so it's very clear that the literature documents that the share of profits was shown to be increasing. And most of this increase is accounted by rising dividends and interest payments, or what they call as rentier income. While the proportion of retained profits even in the non-financial corporate business like auto industry and so on was declining. Okay, that is the retained profit is the savings that they have at the end of the day in their balance sheets. So that is declining. Okay, and this is the research by Dunpat and so on in the case of Germany. This is absolutely clear. They show it very nicely in the paper. Osland, Onaran, and Stockhammer group, they have showed that the increase in profit share is driven by, well, again, they reinforce the same result, that it is by, through the rentier income, the interest and dividends part of the profit is much higher than the non-rentier income, that is profits arising from production, okay, commodity production. And we also saw the divergence between rate of profits to capital stock. So pi by k, profits to capital stock, that is the rate of profit, and the rate of capital accumulation. That's also, rate of capital accumulation is falling while the rate of profit is rising. That is, okay. That's again very well documented in various studies. Stockhammer in 2004, Duminil and Levy 2004 is a very, very interesting paper. Bakir and Campbell. Then increasing share of non-financial corporations' income is contributed by financial assets rather than real tangible assets. This is a firm level data from the US by Aurangzeb and Aurangzeb himself, 2008, published in Cambridge Journal of Economics. So in terms of profit share, profits as a functional income classification, you know that this is clearly that we see in the literature that there is it's skewed towards the most is coming from financial income, interest and dividend income, or what they call as rentier income. It is increasing. One, share of profits is increasing, very clear. And in that, the increased majority is contributed by the rentier income at the expense of non-rentier income. At the same time, you see rate of capital accumulation is falling. Okay, so this is the first stylized fact. Wage share, as we saw, share of wages is decreasing in the advanced economies, including OECD countries, from the mid-80s until the Great Recession. This is Stockhammer 2009, 2013. Again, June part 2030. That is, there is evidence for wage share. Within wage share component, this is interesting. This is within wage share component, there is a widening disparity between the top management earnings and the rest of the workers. Eckert-Hein, 2012, now it's published in Cambridge Journal of Economics, and Andrew Glein and Dunpat. It's a total, people reinforce this over and over. So the CEO compensation, okay, CEO compensation and top management compensation, which is classified in the national income accounting as part of wages, okay. Now the way they negotiate the contracts is that the wage income is much lower because of income tax implications, and they claim the equity stakes in the company, okay. And that is the proportion of the share of financial stakes in the company in which they are on the boards or so on, is the ratio of that in terms of equity income, stakes income over their actual wages. That's the way the wages or the contract is negotiated. So within the wage share component, okay, you have the intra disparity between the top management income and the rest of the worker. So it's a working rich vis-a-vis working poor, as it is called in the literature. So the top management executives is basically from the equity stakes in the company, include various stock options, buyback options, and so on. That is Eckert-Hein. That paper is also available on the net, and I've given the reference to that paper. He also points out the management salaries. In fact, when the profit share is rising, so wage share is falling, right? That has to happen. So, but the fall that is basically the rate at which they're falling is dampened by the increase in the management salary, because that also forms the part of the. So that is interesting. It's dampened the fall in the rate of fall in the wage share component since the early 80s. Now, the empirical evidence in the literature, as far as scoping this literature, if you have a broad brushing this literature, is quite unequivocal that it is not the direction of movement in the share of profits and share of wages, but also unraveling the intra-income disparities. If you take income categories of profit and wages, not only the disparity between share of profits and share of wages, but also there's an intra-income disparities between these two components, okay? Now, in terms of profit share, it is the disparity between the rentier income arising from the financial assets, holding of the financial assets, vis-a-vis the non-rentier income from commodity production. In terms of wage share, there's a widening gap between the top management workers' income that includes various equity options and the rest of workers' wage income, okay, based on commodity production, employment and commodity production. So working rich and working poor. And this period, what is called as the financialization, has clearly established earning from financial assets play a key role. That is for sure, that we can clearly establish that financial income comes from various financial positions and the expansion of financial markets and so on. Instruments markets facilitated by the policies and so on. So given the top management's workers' income is accounted part of compensation to employees as part of the wage income category, the impact of increase in earnings from financial assets accruing to wage income triggers an apparent increase. It looks like it is not falling as much, but because of this, compensation is also part of the total wage bill. So thus at any given level of share of profits, the apparent increase in share of wages arising from financial gains creates an illusion of distribution across the income categories, even as the intra-income category disparity is worsening. Okay, so your retained profits of the let's say the firms of the firms are decreasing, or retained profits is decreasing. So whatever they get in terms of the financial flows from their positions, they are circulated, they're distributed as part of distributed profits into the equity owners of shares and so on. So it kind of creates an illusion of distribution at any given level of profit share. But if you let both, when these guys are both changing, profit share and wage share is changing, the distributional disparity becomes quite complex. It is, so profit share is rising, wage share is falling. Within profit share, the rentier income is rising vis-a-vis the non-rentier income. Within wage share, again, the top management income is rising vis-a-vis the rest of the workers. How this will actually impact aggregate demand, output, employment, and growth is still not clear. Okay. So in particular case of the illusion of distribution discussed just above, the increase in profit share leads to an equal decrease in wage share. Fine, that's very clear. In actual fact, it gives rise to a deterioration in the intra-income distribution in the wage share. That is the wage share between wages and financial income. So you might think that, okay, wage share is not falling as much. Oh, I'm good. If something is not falling as much, is fine. But in actual case, the intra-distributional disparities actually worsens. Okay, and that comes out even in the personal distribution data in Piketty and Saws and Alvarado. Thus, in general, when both this inter-distribution and the intra-distribution change, the way aggregate demand and output will change is kind of not very clear. Okay, it's still kind of we don't know how which way it will go. So at the backdrop of all this, you have this unfettered expansion in the era of financializations in 1980s was guided by the monetarist / efficient market hypothesis, right? Was, yeah. Everybody. That's right. Yeah, it's right. It is the top 0.1 of the wage component, top employees. Yeah. That's also true. Yeah, the total wage bill can increase because by. Yeah. Yeah, one has to see what happens in a surplus, labor surplus economy like India, how it works. It's because I have seen that when technology came, I mean, banks, when they had the computerized in mid-90s, late 90s, you still had the ledger. They type in their terminals, but they still write it. And even now we see in airports and so on, they not only give the ticket, parking ticket, they also write it at the back. Somebody sits there, right? So the technology can be labor augmenting as well. It may not be labor totally, labor surplus economy like ours. It's an interesting point. I don't know how it. Maybe somebody works on this to find out whether it's actually replaced labor or. Increased, yeah. But now, of course, I don't know how it goes the other way. Yeah. In Ireland, I mean, it's both technology as well as the austerity policies and so on. If you go to a bank, there's nobody there. It's all machines. Like, you have one person, two people sitting there and so on. It's all like automatic. Everything is mechanized. So it is labor displacing, as I can see. And, it's, yeah. So in any case, so this is, this is what you actually see in terms of wage share and profit share and the intra-distributional disparities that's been evolving since 1980s. It's not today. It's been there for some time. At the backdrop of the the policy, let's say policy framework, which is informed by this monetarist orthodoxy, whose fundamental aim is to minimize any kind of distortions, intertemporal trade-offs between present and future consumption, as you saw in terms of expectations and so on. So it basically dependent on the primacy of markets and market sentiments, as you can clearly see from Jose Manuel Barroso, including a politician. He says, well, without confidence, we have no investment, and without investment, there is no growth. So the entire facilitating, the policy framework facilitated the deepening of financial markets, debt markets, all kinds of new instruments that came into place, as Warren Buffett calls this as weapons of mass destruction and so on. So financial innovation is at the bottom of this expansion of the financial market. So this period, which is called as the financialization period, gave rise to the biggest expansion of the century, also drove the economy fragile because of the widening intra and inter-distributional inequalities. These intra and inter disparities, income disparities, created the preconditions for systemic instability via defaults and lack of demand in the economy. So this is the alternative, story that we are trying to give, and it is embedded on the data that we actually see. The data of the distributional disparities, both inter and intra-distributional disparities, and also the institutional detail that one can go through in terms of how the financial system itself is, working. What are the institutional framework under which it works? You can see that stark, reminders of such how fragile the boom was is that you see the bottom 90% average income in black and the average personal consumption expenditure. Look at the difference between the consumption expenditure and the income, average 90% average income. So the rest is actually funded by credit. The difference is basically funded by credit. Because you cannot sustain that levels of consumption with this much of income. So that gap is obviously it's funded by the credit. And again, it's another way to look at consumption growth in the US despite stagnant real wages. Even if you take real wages are stagnant for some time, from 2000, quarter one to 2013, quarter three. But the consumption growth, the personal consumption expenditure in billions of chained dollars. So you can see that the consumption has picked up. I mean, consumption has grown way beyond the average real wages. So how do you approach? Now, this is the data that you have. This is what you see in reality, if I were to say, use the word reality. I mean, if you come with a framework of equilibrium, if you come with a framework of price market somehow equilibrating the economy and so on, that did not allow you to see this data, isn't it? At one level, you were not able to see this data. You didn't have the model in your mind, did not let you to see this data. And this is actually what's happening since mid-80s. The income distribution, income inequality, it was deteriorating. If you take in terms of personal size distribution, functional distribution, you clearly see that. But at the same time, you had a boom. And that is partially, totally funded by credit. And there was an expansion of credit. So the financialization process, in a way, it has masked this negative effects of income inequality for extended periods of time since the mid-80s. Such expansion is possible because of expansion in credit via financial innovation, various forms of financial innovation. Okay, not because of the ill-focused debate that happened immediately after the crisis that China and India had stored massive amounts of foreign exchange reserves, what they call as global imbalance debate that happened for some time. So the financial innovation created this myth of infinite supply of money supply in the system. So over and above the financial money supply given by the central bank or the monetary authority, whether you take M1 or M3 definitions of money supply, M3 or M5, the financial sector was able to create whatever money in whatever form they would like to have. They created this, what the literature calls as the endogenous creation of money within the financial sector, which facilitated this expansion of credit in the real economy, which in turn funded the consumption boom. So in a sense, if you say that, well, the way you work through this, so if you say that your output is determined by, in terms of expenditure, consumption, and investment, okay, so this is your, and we know that this is falling, okay, the real capital accumulation is falling, right? But this fall is more than offset by increase in consumption, funded by capital gains or financial income, interest and dividends, right? So your consumption actually outweighed, increase in consumption actually outweighed this negative composition effect that is composed against the real tangible investment in the economy, and that kept the economy going. So the demand was there, that means consumption is growing, that created demand for credit, and which in turn the loans were given, and those loans were further securitized, re-securitized, and that created a kind of endogenous money creation in the financial market, which in turn gave them the interest payments or the financial flows to funnel into the real economy of credit. So this was growing. At the same time, underlying this expansion, you see this intra and inter income disparities were lurking behind. And this created a robust yet fragile, or what you call the systemic fragility of the system. And the defaults were coming from the income inequality. I mean, it is the income disparity that actually triggers, it creates the preconditions for default in the system. Now, this is what we are trying to argue as an alternative story, alternative theory for the crisis. That financial innovation, the interaction between the real and the financial sector, the role of money in production and distribution. Keynes never bothered about distribution of income. Keynes only talked about output and employment. So it is this alternative vision one is trying to articulate and try to understand. How do we say this story? Because that expansion was maintained. It was for a longer time, since the late 80s, because of this financial innovation reinforcing the economics of monetarism. And politically it was feasible because it's, you can maintain inequality at a politically feasible level, because there was no, inequality is a big deal. Unemployment is a huge, it can create crisis, social crisis. But you didn't have any of it. You are, clearly it was a smooth functioning economy with no upheavals, nothing whatsoever, and apparently everybody was happy, right? You were able to maintain the inequality that is lurking underneath this expansion at a politically feasible levels for a longer period of time through masking because of this financial innovation and so on. Which, yeah. Yeah, this is a closed economy, yeah. Yeah, the leakage from the closed economy to, this is at a very simplest possible level, keep that as a closed economy, and open economy so the investment will go to, let's say, India or China. But then, you see, the contracts are not the contracts that you have it in the US, the labor contracts. So casualization, actually increases the precariousness of labor in this. You can still reproduce the same intra-income disparities even in China and so on, even if capital moves from one place to the other place. Right? So what are this is what one is driving for. So you have the dominant diagnosis that you have, that okay, it's subprime crisis in financial market, you need regulation. So if you have regulation, proper regulation of financial markets, then everything will come back. So that's exactly what's going on in a sense in Europe, that the regulatory framework is basically what they now call as simple, transparent, and standardized securitization. So they have huge regulatory revamping of the regulatory framework to say that the securitization can happen only in a particular way. Okay, so and the most important part of that is self-attestation. You have to attest. Whoever creates the liability will attest themselves that this is actually conforming to certain rules and regulations, certain criteria, and so on. This is what's going on, and the politics of it is very interesting because it's all through consultation process, democratic process of consultation, and there's a lot of lobbying by the financial houses to kind of create a structure, create a regulatory structure in a way that it can actually be beneficial for the dominant players in the market. Even rating agencies have no favor within the EU system, but rating agencies are coming back in this kind of a framework where they can play a major role, because in this new regulatory framework, the onus is the responsibility of the issuer. It's on you. If at the later stage, if it is found out that this is gone, this security is not good, that defaults happen in the security, then you are liable for the entire damage. On the other hand, the buyer should actually do the same due diligence, to the best of his ability to figure out whether this security is actually worth to invest or not. So it's left between the buyer and seller. So there's regulation will come at ex post. It becomes an ex post mediation after all this happens. So that's where European regulatory framework is going. Anyway, that is the main argument. So the source is your subprime and the financial innovation, the financial markets. Whereas the alternative story that we saw from the data, what you see is the disparities that, how it actually created fragility in the system in the real economy, not because you had some subprime. Subprime itself is a manifestation of what happened in the real economy, the disparities, intra and inter disparities. So the challenges that we have is at two levels. You have substantive challenges, so articulating the role of money in determination of output, employment, and distribution, income distribution. That is, so this is kind of rewriting macroeconomics or reworking macroeconomics to take into account in the context of modern financial economy, financial sector. How does it impact, output, employment, and distribution? I'm reminded of Wynne-Godley, one of the one of the best proponents of this so-called stock flow consistency macro models. He talked about 7 unsustainable processes in the 90s. The 8th one, unsustainable process that we now have in the literature is this income inequality. If you look at I've shown a lot of data, just to remind you from Piketty and Saws again, that the income inequality, the root cause lies there, and then the feeble recovery that follows the crash, also depends on this process, right? The feeble recovery, austerity process is compressing wages, and it's further, increasing the intra-distributional disparities. So just to remind that this is the Piketty-Saws group data that you saw, top 10% income share between 17 and 2010. So what we are trying to do is, we're basically arguing that, okay, we need to revisit this old problem, the interaction between distribution and level of income and growth through modeling the interaction between real and financial sectors. That is basically you're deriving a monetary theory of production and distribution, which can provide insights into the mechanism that underlies what we saw in terms of growing inequality during the growth phases, as highlighted by the empirical facts in the literature. The analysis must be based on, you need to have a consistent framework, because you need to move away from on the behavioral assumptions. You look at the accounting footprint of an economy and work from that accounting see the economy as a structure from the accounting footprint and look at the institutional details and try to build a model from that for policy calibrations and so on. And in addition to all this, we also have the stylized facts such as there is a steady build up to the peak for a longer period, and there is abrupt collapse in the financial market, which in turn impacts your real economy, and the real economy lingers in this recession for a longer time before getting back, if at all it gets back to the original state or lower than the original state. So this asymmetric, what happens, asymmetric hysteresis is what needs to be taken into account. The time scale is very different. Boom and recession and the collapse, all the time scales are different. And the institutional character of the modern financial sector has to be taken into account. And the influence of asset price and so on. And the capacity of financial sector to endogenously expand money through financial innovation and so on. So this is basically the kind of, from the data, this is what we have. This is the challenge that we have. And the winter school, the themes in the winter school that we have is, it basically ties to this narrative that we need to, ties to this challenge, the challenges that we have. So you need to revisit this macroeconomics in the context of modern financial sector. And Professor Amit Badri will deliver that in terms of how do you, see macroeconomics in the context of using simple models of financial capitalism. How do you see macroeconomic, rewrite the macroeconomic equilibrium conditions like savings equal to investment and so on. Then we need to understand the evolutionary and institutional analysis of financial capitalism. That will be delivered by Professor Gary Dembski, who is an expert in this area, and he's been working a lot on the financial sector itself, looking at the shadow financial sector in the US and UK, and a proper grounding on the price mechanism of the general equilibrium theory, which will be delivered by Professor Anjan Mukherjee from JNU. That is the third, that is the second module, let's say. That's the microeconomics module. And we need to understand, how uncertainty, risk plays in pricing financial products and the impact of all this to systemic stability. And that's Professor Mrinal Ghosh and Professor Shrikant Iyer. They will talk about it. Shrikant will also give a little bit of mathematical preliminaries for pricing various complex products. Both Mrinal and Shrikant will do that. And introducing the framework of stock flow consistency will be delivered by Professor Gennaro Zezza. This is the alternative, this is one of the alternatives that's there, very popular in Europe and the US, stock flow consistency models. They're now beginning to say that, well, this is an alternative model, TSG models, why can't you use this in central banks and so on. And, well, interconnected and systemic risk is a theme. If you look at economy as balance sheets, interconnected balance sheets, how a systemic risk emerges due to these interconnections. There's a fertile literature, very interesting literature on the network theory, looking at how systemic risk spreads and so on. So again, Professor Shrikant Iyer will give a lecture on systemic risk using some of the very interesting models and modeling the abrupt transitions that you see on dynamic instabilities. That is something that we see that you have a sudden crash and then market lingers, or the economy lingers in a longer time. So if somebody policymaker asks, how long will it take for the economy to get back? If you rely on DSG model, you'll come up with an answer. And so a fresh way of looking at a different way of looking at it will be delivered by, which is, well, physics and ecology and mathematical literature, the bifurcation theory. that will be delivered by both Professor Vishwesha Guttal and Professor Petri Piroin, and that abrupt transitions and dynamic instabilities. So there is a connecting theme in this winter school. None of these, everything is building upon models previously taught in this school. None of them are independent. So this is what we're trying to do here. We're trying to the substantive content. What is the substantive issues that we have in the light of this crisis? And what are the challenges, substantive challenges that we have in economics and macroeconomics? And given those challenges, how do we model them? How do we understand them? How do we use them to come up with alternative models? And that's where this winter school is quite unique, in the sense that it's also bringing in this novel interdisciplinary aspect. So we take modeling methodologies from, let's say, catastrophe theory or ecology or physics or even networks but the essence of this workshop or the winter school is that we start with the economic question. This is what Professor Badri has taught me in all my PhD life, that you start with the economic problem and then try to figure out how to understand this economic problem. And this is what we're trying to do in this winter school. And we have winter schools in Europe and the US, and we have seen that the interdisciplinary aspect is not, it's kind of minimum. There's a lot of post-Keynesian or heterodox macroeconomics, winter schools, summer schools. But what is unique about this school is this interaction. You are exposed to modeling methodologies from other disciplines, which you can, given if you're clear on your economic problem, you would be able to use these alternative ways to think about these problems in a novel way. I hope this winter school is useful, and I don't think it will end here. I hope that this will continue here for some time, if not every year, at least once in 2 years or so. We hope that you will have a very useful and productive time here. And the posters that you will put up on Tuesday, next week, anybody can comment, everybody can go and talk, and we will have a fruitful discussion on the posters as well. And if you have any other queries relating to arrangements or the lectures, lecture notes, please don't hesitate to ask us. I hope it will be very useful. Yeah, thank you. Oh, yeah. No. Yeah. We are talking about a closed economy. We're not talking about, it's not necessary that even if you open up, this is not necessary that, yeah. Or you are just in the secondary market, you are selling the ownership here. It's a gross fixed capital formation. Yes, it is investment capital. The brick and mortar is capital. Yeah. Oh, once the house is built. Then see, and then it's like this whole, see, the housing prices were going up because of the financialization, right? And the house was being maybe sold, somebody buys it, and then the expectation that the price will go up. That is, yeah. Selling it in the secondary market. That is a capital gain. Yeah, it's a capital gain. It's not the change in stock, but it is the, yeah. Yeah. See, notional wealth. So if your house value has gone up, let's say original value, say whatever that means, is about 100 euros. Suddenly it has increased to 500 euros. It's a notional gain. It's an unrealized gain. Unless you sell it, you are not going to realize it. It is sitting on you're sitting on a notional unrealized gain. Yeah, that's what was happening in the US. You can actually leverage that to say that, look, because that is the collateral for your loan. So you are sitting on a collateral. You were sitting on a collateral worth of 100 euros. Now you are sitting on a collateral worth of 500 euros. So you have a gain of 400 euros on the collateral that you have on me. So either you give me a kind of a loan, additional loan, or you somehow distribute that. It's called equity financing. I don't have the data. The consumption, I think I did. Initially it did, yeah. See, what they're showing right now after 2009 to 2014 in the US data, the profit share is increasing. With that, your consumption is increasing. Rate of capital accumulation is falling. That is for sure. That trend is keeping up. But share of profits has risen. Your consumption has come back up. So it's a kind of, it is that part of the interest and dividend payment part which is funding the consumption. These are very open questions. So they're still figuring out why in a secular stagnation scenario in the US, why is the share of profits up? Right. Yeah, but you don't see when you see you have a general level of unemployment. It's about, let's say, 6 to 7%. Now, even if you hire labor, cheaper labor, it's not you're still losing that demand, right? Your demand is, it's not automatic that you will have the same demand before and you will realize this profit. What we're trying to say is that the profit share can also rise in terms of deleveraging. So you mean to say that that markup gives them the profit? But where is the demand coming from? They have to realize the profit, right? Sticky prices in what? In where? Product markets? Yeah, consumer prices have not fallen as much as it should have fallen in the United States or even in Europe. If you go by normal, if you compare with 1929, the kind of Great Recession, that has not happened in this recession. That's one of the most stark difference actually. That was very much kind of a deflationary recession. This time was very much favored actually. It didn't allow price to fall. Maybe that explains something about these profits here. If you compare 1929 recession and this recession, prices are not comparable. You're saying.
insane surge in profit. Any character, not one. The global commodity prices are all time low. So, and normally prices are sticky at it. If the prices would have fallen proportionately as they fall, like or as they fall in great depression, possibly then the corporation's profit there must not happen. This time prices did everything happened in the same manner as it happened in great depression. Almost everything. Stock prices fell, unemployment increased, but nominal prices didn't fall. Thanks to Friedman wisdom act, central bank adopted. You can kind of say animals against him, but it was Friedman's wisdom action that he adopted this time and didn't allow prices to fall. So somehow, and one more thing that when we say about this great sale, it's not happening because of labor displacement. If somebody feels that great sale has declined because of labor has been displaced, that's not factually true. Because if it has been falling for displacement, then we must have seen market unemployment in Europe and United States. That never came.
We didn't talk about displacement, labor
No, you
displacement.
can say some conversation like happened about displacement. You must not relate to displacement with decline in wage.
No, that literature does not talk about displacement. The decline in wage share does not happen because of displacement.
Yeah, I'm just trying to clarify this because we haven't seen an unemployment actually in US, nor the worst phase of wage share decline has happened without any unemployment.
Which phase is this?
1980 to 2007. The wage share declined actually, everybody knows that it was the kind of most adverse period for wage share. This happened in both sides of Atlantic without any unemployment actually. This was the best time for employment. If you like left out, if you leave out the small kind of two-pay recessions, then for the workers it was the best time. We don't know how and why they agreed to work at a low wage. That we don't know. The wage rate is problematic thing.
The real wage was stagnant.
Yeah, that is the problematic thing.
See, but what you are not taking into account is the financial incomes that they earn from their investments. That is also part of their income.
Yeah, but displacement never came actually.
Displacement is not an issue at all. Stockholmer, that literature does not talk about displacement. It is this characteristic of the financial flows that they get from their positions on financial investment vis-a-vis their, let's say, real income from commodity production. That is the that's what I'm talking about, the intra-distributional disparity. That's what they're picking up, not displacement.
There is a view actually, all these coming from Milan from World Bank Keynes to Europe. Keynes now again, even Roberts recently commented that somehow I don't know how to do share decline. He's saying that basically the growth model that I built was based on some fixed proportion of labor and capital share of income.
Who's Solos model?
Solos model, actually, the basic Solos model. And he said that was the kind of established wisdom. And I somehow think like include the idea of Robinson of imperfect market action. That there is a market pricing. Jonathan Robinson was working that time on imperfect pricing actually. That the markets are not perfectly competitive. Product market actually.
Right.
So now he is saying that this is time to revisit actually. He is talking about the markup in the product market.
So you don't have to revisit. There was Michael Kelesky's work was this.
But nobody brought this into a growth model, formal growth model.
No, there is a whole heterodox literature based on this. I mean, yeah.
context, 60% of the large firms account for less than 30% of total tax paid by the Indian corporate. And the smaller firms pay larger tax. So the rates are different. See, what you're saying is the primary one is saying that small firms cannot have the retained profit to ensure that when they do not have sufficient access to credit channels, they can use their retainers. So the larger firms always keep a market on their retainers. So even if when the credit cycle is distorted, the economy does not allow them enough to support this for credit, they can utilize their for some period in their business cycle. That's why the rate of interest affects the smaller firms more rather than the larger.
My point was not exactly the same. I will just take one or two minutes. What I was trying to say that in
Formal growth modeling of which literature? You see, there is a very massive, there is a hell lot of literature. Yeah, you see that there is no distribution in that literature, right?
distribution was there, but somehow Solo believed that the distribution will remain constant. Distribution was there. Then in neoclassical growth theory, you can go and
Marginal product, yeah.
you can calculate. So he believed in the idea of like competitive product market and competitive labor market. Now what he is saying that somehow I was misguided actually, and someone should go and revisit this model with a kind of monopolist product market and some kind of labor market where bargaining plays a role. If you develop such a setup, then you can somehow bring the idea of rent and you can attribute that rent as something which has led to a rise in capital.
I'm afraid there is a very large literature. I can't point out to one or two on the distribution growth. There's not one single article. There's plenty of literature to read on the other side. If you take a look at some of this literature, you will see what you're now saying, or what Solo is now saying. Oh, we should have done that. It's there. Okay, using the basis of imperfect competition. Okay, you talk about growth and distribution. It's
but nobody till now has been able to formally establish it in neoclassical growth framework. So that is, yeah, you are right. Some work has been done. People have tried to find how much is the rent actually, but the estimation of rent is not accurate. The most important, you can say, the most important hurdle in developing such a model is that we don't know how to estimate rent actually. So that is the problem. If we can somehow develop that how much percent is rent actually that a producer is extracting from the market, and if that rent is huge, then somehow we can go and revisit neoclassical growth theory to see how this rent has evolved.
Why would you want to revisit neoclassical growth theory?
Because that is the kind of mainstream literature, and it's the whatever literature, dominant literature, and if dominant literature is on the practice, then you should take the chance to kind of give them your kind of understanding that you have been saying since long. I think the development. So now they are ready to accept it. Dominant literature is almost ready to accept the rate seeking and imperfect forming.
Okay, I think we'll have this discussion in a.
We have a full discussion session.
Yeah, you'll see the afternoon session, Professor Badri's lecture, and we'll talk. Yeah. And you'll also have Gary's talk. So, but there is a entire literature on this. It could be that you have not seen that literature. It's okay. So, Vishu, are we breaking for lunch? Is that?